And let's get started. The budgeted statement of cash flow. Once we create this budgeted income statement and projected balance sheet in a monthly basis, then the budgeted statement of cash flow is just simply created, comparing between 2 month balance sheet and the income statement of each month. We want to reconcile net income because net income is not actual cash, and depreciation expense adding back because the depreciation expense was not actual cash out, but net income considered that is the expense. All the accounts receivable, inventory, prepaid expenses of insurance are the balance sheet asset increase, but the net income doesn't include that changes. The liability also, the accounts payable accrual liability is not considered in the right the direction of the cash flow. Instead, just accrual basis. That's why we needed to add back that accounts payable and accrual liabilities. Capital expenditures. We have only one capital expenditures, the 6,900, I believe, and then loan finance, new loan finance, of the increase or decrease between 2 a month, and then we'll get the net cash flows from financing activity, and the sum of all three business activities, investing, operating, and financing, we get the net increase or decrease in cash. And then the beginning cash balance adding, we got the ending cash balance should be the same as the balance of cash on the balance sheet. And then we'll calculate cash burn and cash bill to get the net cash bill on a monthly basis. Okay, let's go. Net income of the month, starting from 460, and then depreciation expense. Again, we need to add back from net income, right? So positive, and then the difference between a 2-month AR that has been increased, but it was not actual the cash as cash sales. That's why reduced. And then inventory increased on the net income. Net income does not include that increase, but cash out when we purchase, right? And then increase or decrease in the prepaid expenses. Also, we need to consider it has been decreased, right? So it is now positive. Increase or decrease in the liability accounts payable, then there you go. The accrual basis liability increase, then cash up. And then accrual liability also between 2 months has been increased. So we got those numbers on the cash flow statement. So let's just sum those up. Sum these up. So 24,000 is operating activity. So on a monthly basis, investors don't like that situation because operating activities in cash generation is actually negative. The capital expenditures are from gross PP&E. There you go, right? It has been increased. That means cash out. Asset up, then cash out. And a loan financed from liability increased. That means cash up. We don't have any other finance activities, so those are positive. The net increase or decrease, we add all the activities, operating, investing, and financing, and this is 0. Beginning cash balance, where is the beginning cash balance? Beginning cash balance is from, right, here you go, the ending balance of the prior month, right? So we got this. And then ending cash balance is 23,000. So let's drag and increase. So let's check if this ending balance is the same as the beginning, the ending balance of cash. Here we go, 23 is exactly the same. right? And then, for example, September 32,000, 32,000, 37,000, 37,000, 29,000, 29,000. We got the ending balance, which is exactly the same as the ending balance on the balance sheet of cash, right? Cash balance. So we found that that is a statement that shows all the cash in and out in terms of the operating activities or operating cash flow from. This is operating, right? Operating activities or investing activities or the finance activities. Now let's just finish up by calculating the cash burn. How do you get the cash burn? Cash burn, we want to see the pure cash out from actual the use, right? So cash burn, we always, right, get the income statement expenses here plus wages plus the rent and miscellaneous expense and insurances, skipping the depreciation, and then the interest expense, right? And then here on the balance sheet, we also use increase in, right, inventory, prepaid expense once again, and then plus accounts payable and accrued liability. Those are all the operatings. Then plus minus capital expenditure. Then we got that number, right number. And then the cash billed is sales plus increase in accounts receivable. So the sum of these two is net cash billed or burn. Then let's just drag to the right. And then we finally got the number here, the cash burn and billed on each month. Okay, that's all. Okay, in the next video clip, we'll discuss about another budgeting, the cash budgeting skills with a simple version. Okay, see you in the next video clip. You guys, bye-bye.